Morning, Susan.
Hi, Ellen. Thank you for having me.
Great. I think you're doing great in your previous round. So are you ready for the case?
Yes, let's do it.
Great. So our client is a large US-based commercial airline that has lost profitability and market share. The company is under pressure to regain its footprint in the industry and grow its balance sheet. Can you brainstorm some ideas that you would like to investigate on behalf of the airline?
Great. So just to recap, our client and their obstacles. Our client is a large U.S. commercial airline, and they have been experiencing decreasing profitability and market share. And they have come to us to have us brainstorm how to regain their footprint and as well improve their balance sheet. Is that correct?
Correct.
Great, great. Just a couple of clarifying questions, if you don't mind. What kind of time frame or specific kind of objective measurements would they want us to keep in mind?
As soon as possible.
As soon as possible. And is there any figure of how much profitability, what profitability figure or margin that they would like us to reach?
We just want the top priority is take the operating margin positive.
Great. Operating margin to be positive. Okay, absolutely. Um, Great. And so just have a couple more clarifying questions. You say our profitability and market share is down. Are there any other major competitors in this region, in the United States region, that maybe are improving in their market share, or how are competitors in the overall market performing?
That's a great question. So our client profitability is declining slightly faster than the industry.
Great. So the industry as a whole is declining?
Yeah, but our client's profitability is dropping a little bit faster. However, it is still in line with other airlines within its class of services.
Great. So the industry as a whole is declining. However, that of our clients, our profitability of our clients is decreasing more than that of its competitors.
Yeah.
Right. Okay. Um, do we have any figures of the current profitability? So profitability has been declining. Is there any information of how long it's been declining or what its current situation is?
We can dive in such details later.
Great, great, absolutely. Let me see. So is there any more information about what our product, this commercial airline is? For example, like Southwest, maybe more budget friendly, or is this more of a high end airline? What specifically kind of market niche does our client kind of make up? Is it more budget friendly, vacationer, business travelers? What is our product? What is our client's product made of?
Yeah, that's also a great question, but we don't have such a clear market niche so far. We just think our client as a regular commercial airline operator.
Great, great. Okay, I just wanted to make that clear. Thank you. Let me see. So we have the industry and client. Let's see.
Oh, and one more information I think that'll be useful is so regarding the timeline for the project, I would like to offer a benchmark. So usually in the airline industry, any financial investment, that typically we're expecting a payback period of 3 years.
Great. A payback period of 3 years. So okay, any investments that we might want to make, we want those investments to at least recoup the cost within 3 years. That's just to make sure. Okay. Great. So okay. All right. And just to totally make sure I have the right idea, a commercial airline, they make their money largely from tickets, right? Tickets and then maybe food and beverage and some other points, but largely the revenue comes from the tickets. Is that correct?
Yeah, I mean you can do some brainstorm and going on, but yeah, ticket definitely is part of our revenue.
Okay, great. I think that's all the information I need for now. Do you think I could take a moment to structure my thoughts and go over my approach with you after I finished?
Of course, go ahead.
Great, thank you. Great. So thank you. So I've come up with a bit of a structure I think would be good to approach this problem. So in our client's objective of increasing profitability and regaining a market share in the commercial airline market in the United States, as well keeping in mind a payback period of 3 years, I've wanted to look into three buckets to address this problem. The first bucket would be the current financials of our clients. So what are the revenue and costs and what are the current profitability of our clients. So looking at his balance sheet to see how our clients is performing financially. The second I'd like to look at is the market. So the outside external factors of that make up our clients. So whether that's the competitors or the customers or maybe the location, perhaps the United States market as a whole has declined in travel. So perhaps there's some inflation problem like we see now, and traveling isn't a big demand for, or just any other factors that could be affecting the overall market, and so would in turn affect our clients' profitability. And finally, I'd like to just come up with some ideas to bring about improving the profitability and the market share. So just coming up with some ideas that could be manageable and reasonable to bring up that profitability. So going back to the beginning, the current financial, of course, I like to look at the difference between the revenue and costs. So within the revenue, looking at our tickets, like we mentioned, the tickets and seeing if our tickets are selling, and seeing what those trends would be of ticket sales, and whether or not there's been a decline or if the prices have fluctuated in volume, and whether the prices have fluctuated or the volume of tickets have not been selling so good. As well, looking at food and beverage and in-flight, whether there's different consumer behavior of purchases on flights or even in the airport itself, such as internet, food and beverage. As for the costs, there are largely a number of costs I'd like to look at, like for example, fuel for the planes, maintenance of the planes, and as well as software that could dedicate the routing of the planes. And so seeing if there's any kind of cost that in this airline, particularly airplanes need the fuel and maintenance, whether or not there's been an increase of those costs for our client. And so those are the financial I like to look at. Moving forward, I like to look at the market, the commercial airline market in the United States. Is, for example, the entire United States market, if there's some kind of external factors like inflation or pandemic or government, new government regulations that require stricter regulations for the airline industry as a whole, whether or not, for example, the location would be a big factor, the United States location. As well, I looked at the competitors. Perhaps there are new products that our competitors are introducing that that we don't introduce. Like for example, differences between business class or first class. You know, I know Southwest, for example, doesn't offer first class, business class, or economy. They just offer one blanket class. And so seeing if splitting up what our competitors, whether they offer services or structure for their planes that our client does not offer, and whether or not there's been a preference in the whole customer base for one type of airline experience versus another. And finally, look at the customers in the market between business travelers and vacation travelers, whether or not there's been a trend in each class of travelers declining or increasing for demand for our clients' airplane and airline products. Finally, I'd just like to come up with some ideas to approach this problem. And so keeping in mind the payback period of 3 years, perhaps we can introduce some new perks on the airline. So better food and beverage on our flight for our customers. Maybe introducing some new ticket sales or some ticket pricing options for some budget-friendly customers. As well, invest in some new routes that could be added to our airline to give a more comprehensive travel experience, travel offerings for our clients, customers, and perhaps even more in-flight amenities such as putting Wi-Fi or more comfortable seats, or differentiating the airlines that we have, what our client offers its customers, and perhaps maybe merging and acquiring other smaller airlines to broaden its reach or broaden its product offering, or perhaps even investing in more higher quality planes, for example. So that was along for a little while, just the current financials, market, and ideas to address the problem. From this, I'd like to first look at the current financials of our client to see whether or not there have been costs or revenue increases or decreases that have been the drivers of this problem of decreasing profitability for our client. So is there any information of our client for on his current profitability, and where any trends that could be leading, that are primarily responsible for its decline?
Yeah, I like your framework. It's very solid and strong. But moving forward, even though we like your idea and our client want to evaluate the idea you just mentioned, they want to add additional routes. So the flight dispatch office has presented 3 routes and would like you to your guidance on which one to choose. So yeah, just 1 second. Let me pull out the graph.
Sure.
Yeah. Would you allow me to share screen?
Oh yes, let me do so. And sharing option. Here we go.
Great.
Can you see it now?
So can you see it?
Yes, I can see it. So
Yeah, this exhibit, regarding the airlines, I will share 2 exhibits, but this is the first one. You can have a look at first, and I'll share another one later.
Great. Okay, great. So just to take in this exhibit, I see 3 new routes that our client is interested in adding to its route offerings for their customers. I first see Seattle to Minneapolis, and then New York to DC, and Fayetteville to Dallas. And in each route, I see that there is information about the distance of each route, the number of round trips that can be made each day, and the passenger capacity for each. And so just Seattle to Minneapolis, 1,400 miles, 1 round trip a day, 240 passenger capacity. And from route 2, we have Fayetteville to Dallas, which is 550 miles, 1 round trip per day, and 120 passenger capacity. Finally, Route 3, New York to DC, 200 miles, 3 round trips per day, and 120 passenger capacity. Okay, so the question our client wants to answer is which of these routes should be included in its route offering. And so
Correct.
sorry?
Correct. Let me put out another exhibit.
Okay, great. Here we go. So let's see. So not only do we have the kind of numbers of each route, looks here in this route research that in each of the routes 1, 2, and 3, our client has done some research about the potential growth, risk of flight disruption, and competition for route. And so also a time to establish operations. And so as well as the potential of growth is a projected 5-year increase in passenger volume. 2 would be historical data on flight cancellations due to weather and current competitors flying the same route, competition for route. Okay, so with each of the 3 routes being compared here, I see that there's kind of plus and minuses, pros and cons of each route. And so with the Seattle to Minneapolis route, we see a low potential for growth, so that would be a minus. Just trying to compare each route to see what are the pros and cons of each route. Risk of flight disruption is low, so that's great. And high competition for route is high, so that's a negative. And then 3 months is a relatively compared to, for example, the Route 3 is quite low. As well, the potential for growth for Route 2 is high, so that's a positive. Risk of flight disruption is high, so that's a negative. And competition for us is low, so that's a positive. And finally, for Route 3, medium potential for growth, so that is pretty medium. Risk for flight disruption, I would say also a medium. And competition for route is high, so that would be a negative. And with 2 months and 12 months. So just looking at all these flights, it looks like each of the routes have kind of pros and cons. I would lean towards away from the New York to DC route, just because it doesn't seem like there's any particular advantage. But of course, as well with the 12-month time to establish operations. But it seems like all the routes have just a pretty, you could argue for most any route. Also, I'd also like to consider that there's a 5-year increase in passenger volume when we like to make up our payback period in 3 years. But pretty much overall, I'd like to say that all of these routes seem to have a pros and cons. And so I am leaning towards the lower time to establish operations, but again, with the potential growth to be medium for Route 3. Okay. So
what's your conclusion? What's the next step?
Right. So with the next step, I'd say that all three routes have a pluses and minus, so I can't just off the bat choose which one. So from this, I like to see which will ultimately have the lowest cost and the highest revenue. So is there any information on perhaps the fuel costs or the maintenance costs, or if there's any information on ticket revenues or the number of volumes that could be, price versus volume? Is there any information on the financials of each route, whether it's ticket sales or the cost of fuel or anything like that?
Yeah, actually, we do have, and we have some financial projections, and I would like to share with you. So for one session, and there are also another 2 exhibits. This is the first one.
Okay, great. So just to take this in, the exhibit 3, the upfront costs for each route, as well as terminal construction, equipment purchase, and additional staff required, are given for each route. So with the upfront cost, just keeping in mind the payback period of 3 years that was given in the objective, this seems to be the upfront cost that for each route. And so because we want to come back with a payback period of 3 years, this is the initial investment. I'm sure that would be required for opening up each route for our client. And so I'm just going to quickly 2 and 3, just quickly take in this information, construction, equipment purchase, and additional staff required. So 100K, 2.5 million, 5 million for terminal construction, 1 million equipment purchase, 3 million for route 2, and 1 million for route 3. And this would be additional staff required would be 10K per person will be required for training. Okay, so we have 10 people, 100 people, and 50 people. So because this is the upfront cost, the initial investment, and we have a payback period of 3 years, what follows immediately is with this initial investment, can our client recoup the initial investment within 3 years? And so what comes to mind is there any information on the revenue that will be introduced by each route? So either the price or the volume. So is there any information on the revenue that
Yeah,
each
we
route
do.
will bring in? Or
Yeah,
the
we do.
Great. Thank you. So, okay, great. So in Exhibit 4 here, we see the route financials per ASM. And and then the route financial per filled seat, and then the average percent fill rate of each route, as well as some revenue and cost information. Just to clarify, what does ASM mean?
Yeah, let me 1 second. So actually the ASM is the ASM stands for available seat mileage. So there is an equation here. So available seat mileage is please give me 1 second to pull out the so the equation here is equal to the number of seats available and multiple by the number of miles. So this is the measurement of an airplane carrying capacity. So slash is their capacity to generate revenue. So I hope that information is helpful.
So it's okay, available seat mileage, which is number of seats available, number of miles. And so we also have the average percent fill rate of each plane for each route, as well as the profit for each route. And so, or the revenue and cost per filled seat of each route. So, taking the number of seats, could I take a quick moment to structure my thoughts how I like to approach this kind of math problem?
First, please.
Great. So, okay. Number of miles per ASM. So, okay, number of seats available, number of miles. Route financials per ASM. Okay. Number of seats available, number of miles, and we also have number of miles for each route. Okay. ASM. Per ASM. Oh, I see. Per ASM. Okay, per ASM. Profit per seat per ASM. And so we're going to multiply the number of seats available. And then that would be number of miles. Oh, I see. And then we want number of years.
So just let me know how you want to tackle this problem.
Great.
What
So
structure you have?
right. So here we go. So this information on this exhibit is the routes per ASM, the financials per ASM. And so I'd like to take the number of I see. So I like that this is the route per ASM. And so there's a percent filled seats times the the profit per seat per ASM. And I like to multiply that by the number of seats per route, multiply that by the number of miles. So ultimately, the profits for one trip of each route. And then from that, I'd like to look at multiply that by round trips or number of trips per day, because that would give the profit per day, and then multiply that by the number of days in the year to ultimately get the overall profit that would be made for each year by implementing each route, and then finally having an annual figure for how much profit there would be. I'd like to look at how quickly they would recoup the initial investment cost. So just first overall calculating the profit for each year, and then figuring out how long for each profit would be able to recoup the payback period. So does that sound like a reasonable approach to you? Just to throw to you.
Uh, I think this is a very good structure. And let me repeat that to make sure that we're on the same page. So your first step, you want to calculate the profit per ASM, and then you want to calculate the ASM. And when you get the number, you want to multiply the number with the flight per day and days in the years, and then get the annual profit and and to figure out the payback period, right?
Yep, that's correct. Yeah.
That's fantastic.
Great, great. So I'll just go ahead and kind of structure my thoughts, but I'm going to make a quick table to look at each route. So let's see. So for route 1, 2, and 3, for each route we have the number of seats, which is for route 1 is 240. And for route 1, 120 for route 2, and 120 for route 3. And from that, we have from this exhibit the percent of seats filled to be 90%, 90% for route 1, 60% for route 2, and 80% for route 3. And from that, we also have the number of miles per route from the first exhibit, which is 1,400 miles in route 1, 550 miles for route 2, and 200 miles for route 3. And finally, we want to look at the profit, the profit per filled seat per ASM. So we have the ASM, we have the miles, and we have the number of seats. And so we want to multiply that by the profit per filled seat. And so for route 1, profit per filled seat. So route 1, that would be a 12-cent revenue minus the 11-cent cost. So that would be a 1 cent profit per filled seat for one trip. For route 2, it would be a profit of 0.22 minus 0.09. So that would be 13 cents. 13 cents. And finally, we have a Route 3 of 6 cents. So 6 cents. And that would ultimately give us the number of that would ultimately give us for 1 day. And then we also have the number of round trips per day. So for Route 1, it would be 1 round trip a day. So would that be fair to say like a round trip per day is 2 flights, 1 there and 1 back? Is that fair to say?
Yes, and so the flights per day, you can take the route 1 is like 2 flights per day, and route 2, 2 flights, and route 3, 6 flights. You're correct.
Great, great. So Route 2 would be 2 flights per day, and Route 3 would be 6 flights per day. Okay, so ultimately have flights. That would be per day. And so we have per day now. I want to look at how many, I would imagine 365 days per year. Is it fair to say 350 days per year with some holidays? How many days per year does our airline operate?
Great question. We plan to operate 300 days per year.
Great, 300 days per year. 300 days per year. 300 days per year. And so now we have financials for each day, and now we have financials for each year for each route. So I think I'll go ahead and perform this calculation so that I get the annual profit for each route, and then ultimately see what those payback periods are. So going first with Route 1, we have 240 number of seats with a 90% fill rate. So divide that by 10 is 24, and so I'll subtract 24 from 240, which is 216 seats filled. Route 2, 60% seats filled, so I'll divide that by half, which is 60, and then add a 12, so that's 72 seats filled. And 120 seats for Route 3, 80% being filled. I'll divide that by 5. So that would be divided by 5 would be is 24. 24 minus 120 minus 24. That would be 96 seats filled. So from there, number of miles and the profit per seat, 216 times 1,400 miles. Would you like me to, is it okay if I round some of these numbers? For example,
Sure, of course.
Okay,
Yeah.
great. So with the number of seats filled, 216, I'll actually just round that to, I think, 220. 220 seats per route. Per trip, per percent filled. And so 220 times 1,400, that's 3 zeros. That would be an 8, and then another 0, that would be 2. So 1, 2, 3, 8, 0. So about 308, 308,000. And then with 1 cent per 1 cent per profit per filled seat, that'll ultimately be for 1 trip, it would be about $3,080 per filled seat. Does that figure sound all right with you?
Great.
Just to know, Ellen, we are 34 minutes, so another 6 minutes will be kind of cut off. So just keep that in mind. Yeah. So the next one, 72, I'm gonna round that.
I mean, you can. Could you please finish the route 1 calculation, and I'll offer you the rest numbers.
Okay, great. So that's per trip. So with $3,080 per 1 trip, for each day there are 2 trips. So I'm just gonna round to 3,100, and then multiply that 2. So that's $6,200 a day, and then multiply by 300 days per year. I'm gonna just get that to be, that's 4 zeros, and then 3 times 62 would be 618. So per year we make a total of 1,860,000. Does that sound fair for the annual return for the Route 1?
Yeah, That's around the age, around the range. So let me offer the rest number. So for route 1, we expect annual profit per route is 1.8 million, and for route 2, it can take 3 million, and route 3 is 2 million.
Great. Great. Okay, wonderful. So from this we have the annual kind of profit per year for our return. And so I want to look at the payback period to see what would be, if we recoup the initial investment cost. Could we go back to that third exhibit with the upfront cost for implementing each route?
Yeah, sure. Did you see that?
Yeah, I can see it. Great. So the terminal construction, we have the upfront cost for each terminal construction. Great. And so for route 1, we have 100K, so 0.1 million plus the 1 million, so 1.1 million. And adding the additional staff required, 10 times 10K per person means there'll be 100K, and so another 0.1 million. So that's 1.2 million initial investment cost. With route 2, we have 2.5 plus 3, so that's 5.5 with 100 additional staff required. So that will ultimately be $1 million. So add that all up, that is $9 million investment cost. And finally, with route 3, we have 6 million initially plus the additional staff, 0.5 million. And so that would be a $6.5 million dollar initial investment cost. Do those figures sound all right with you? 1.2 million. Okay, great. And so finally, with that, I'd like to calculate the payback period for each route. So 1.2 million, we have 1.8 million investment cost. So that would mean in 2/3 of the year we would recoup the initial investment cost for route 1. So that would be 8 months for route 1. For route 2, with $3 million per year in annual return, that would, with a 9 million initial investment cost, that would be 3 years payback period for route 2. And finally for route 3, $2 million per year of return with a $6.5 million initial investment cost. That would mean that in 3 years and change, there would be a return. So the initial return would be 2 million. It would be 3 years and 0.5, 3 years and 3 months. 3 years and 3 months. Do those figures sound correct with you?
I think the route 1 and route 3 sounds good. So what's that route 2? What is the payback period?
So we get a return of $3 million per year for route 3. However, there's initial investment cost of 2.5 million, 10K per person, 100K per person times 10K per person. So that's 100K and $1 million. So the initial investment cost is 2.5 million plus 3 million, which is 8 million. It would be $9 million initial investment cost, right?
Why it's 9?
It would be, it would be 5.5. Oh, 7 million. 7 million.
Why it's 7 million? So the construction is 2.5 million, and equipment purchase is 3 million, right?
Yeah, so that's 5. Oh, it would be 6.5 million. 6.5 million. And then so it would be about a two-year payback period. 2 years and change. So Ellen, yeah, quickly let's jump off. We're gonna be cut off in like 5 seconds.
Sure. I'll be back.